Hello everyone, I'll be doing a auditing presentation. Audit risk, by definition, means that the auditors will issue an inappropriate opinion in regards to the financial statements. In this example, I will be representing Deloitte, and a company that I'll be auditing is Ram Trucks, an American car manufacturing company. That there are three components of audit risk: inherent risk, control risk, and detection risk. Inherent risk is a risk that is based on the business nature, and control risk is based on the internal controls, and detection risk is based on the auditors not detecting errors or misstatements. All three of them will cause, or if not checked by the auditors, will cause errors and misstatements to be happen. And for example, in this example, RAM trucks, we find that they're working with foreign currencies, there's rapidly changing technology, and they work in a very volatile market or industry. This will be the inherent risk. Control risk would be that this company works with old software, old computers, and they have ineffective accounting systems in place, and they have another reason would be that they have a poor delegation of duties. So one person records the financial statements and also is the purchasing manager. This is not good. This will cause more likely fraud to happen, and personal authentication is also very important, meaning that only those people who are authorized um, to manage the financial statements should be authorized. No one else should have access to software or computers that are there to manage the financial statements. Detection risk would be that our procedures fail to detect misstatements, or we are using ineffective procedures which are not going to give us a more accurate or best results. And the second reason for detection risk could be that as auditors, we are misinterpreting the results, which will lead to issuing inappropriate audit opinion. Both inherent risk and control risk factor to material misstatement. Materiality, by definition, is more than just a number. It depends on the size, and it depends on the nature of misstatements. Determining materiality, auditors like me use benchmarks like revenue, total profit, and net assets, and we set performance materiality lower to lower the detection risk, but it's applied lower than the material threshold, so that we find more misstatements, detect more errors, overall sample quality increases. In the Iron's case study, we see that Iron was dealing with fraudulent accounting activities, and this was because they were inflating their prices but hiding the nature of their fraudulent activities in small misstatements. And auditors like Arthur Andersen failed to detect misstatements because they were heavily relying on whether the misstatements were crossing the threshold, the initial materiality threshold, or not. But they didn't consider the factor that misstatements have the nature of error. And we see that There are material misstatement factors like fraud risk, regulatory impact, and stakeholder effects. The key lesson is that materiality ensures transparency and trust, but even a small misstatement can be critical. Audit Committee: The purpose of the Audit Committee is to show transparency and accountability and oversees financial reporting and internal controls within an organization, and the members' job is to give independent oversight on the financial statements. They must be comprised of at least 3 independent non-executive board members for unbiased reviews, and the committee works with both internal and external auditors to detect fraud and errors. And the risk management and compliance is that the audit committee monitors risk and ensures compliance with laws and regulations and meet up to date regulations by law and anything that may affect the company by statute. And one real-world example we use is the Fargo scandal, where the audit committee failed to detect that there was fake accounts made by employees to meet sales targets, and this is very wrong. And this led to reputational damage and also massive fines that the company were given by the law at the time. I think it was the United States at the time, and this highlights the fact that the audit committee, having a strong audit committee, is essential of preventing corporate misconduct. The role of analytical procedures in auditing. The purpose of analytical procedures is to help auditors to understand financial data and identify any risks which would cause any misstatements. For example, a trend analysis. As trend analysis evaluates the financial patterns to detect unexpected changes. For example, if a company has significant changes in sales from previous years, or if there is a sudden increase and decrease in the total assets in a company, then there should be a clear inspection or an examination or investigation that should be considered on those significant variances or changes. And the role of risk detection in auditing is that it highlights unusual patterns that may indicate fraud and errors, and this is done through analytical procedures. And the role of efficiency in analytical procedures, where it focuses efforts on high-risk areas, and every organization have their own weak points, where there's more risk in a certain area compared to a particular area, and this is normal in the case of all organizations. And analytical procedures helps to focus risk on high-risk areas. And the last thing is ensure reliability, because analytical procedure helps determine whether the financial statements are accurate and trustworthy when issuing an opinion on the audit report. Engagement quality review is a critical safeguard in auditing, ensuring that auditors maintain high professional standards and issue reliable opinion. It provides an independent assessment of key audit judgments and helping to detect potential errors and misstatements and enhancing compliance and uphold audit quality before the final report is issued. So for a case study of Carlion plc, in their collapse, what happened was the auditors they failed to identify serious financial misstatements and including aggressive revenue recognition, which includes like failure to recognize major revenue and underreported liabilities. So if there was a strong engagement quality review, this could have flagged this risk and persuading for further investigation to happen and potentially preventing audit failures that misled investors and regulators. So EQR, engagement quality review, acts as a vital quality control measure for auditors and ensuring auditors apply due diligence, maintain professional skepticism, and enhance public trust in financial reporting. Thank you very much for listening to this presentation. Have a nice day.